In this video, we're going to talk about 5 reasons people lose money in the stock market. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I've got 5 reasons here why most people, when they're investing in the stock market, lose money. The first one is overexposure or not diversified. So we're talking specifically more about investors here rather than short-term traders. And a lot of videos are more short-term trading, but this is when people are picking stocks they think have got a long-term growth, or they think are going to go higher for whatever reason. This is generally the things that people do that make the mistakes that people make, which means that they're not making as much as they should be, or they're losing money. These are kind of the big things. So the first one, going back to that, is overexposure or not diversified. So people will pile in everything into one stock idea. So they think this company is going to be great, whatever it may be. They sort of fall in love with the whole thing. They pile into it. And if it doesn't perform, it's an all or nothing thing. Rather than kind of splitting their ideas into 10 or into 5 or into more and saying, okay, well, that's one idea, that's one idea, that's one idea, that's one idea, and allocating capital to each of those ideas. A lot of people may have just 1 or 2 and be piled in. Now, of course, if that comes good, that's going to be great for you. But the trouble is, generally speaking, I find that you end up being so over engaged in that idea, so focused on it. You're looking at that stock all the time. You look at the news flow, and even if it starts to go your way, you tend to be eager to take profits because you're so kind of fully loaded with your portfolio value. Whereas if you're diversified, you can say, okay, well, it's 1/10 of my portfolio, or it's 1/5 of my portfolio is doing well. That's fine. Leave it. Let me look at the others. Let me look at the others. Let me generate new ideas. Let me switch around if I need to. But that's one of the main things. People just sort of piling all in to one idea, and it becomes an all or nothing kind of play for them. And also, of course, as the market turns, I know obviously generally stocks will turn with it, but if you've got some defensive plays in there as well, it's going to neutralize some of that down move you get in the broad market. Okay, number 2, investing based on tips. By all means, use a tip service. By all means, kind of get ideas generated to you. But I want to distinguish between the two. It's kind of the same with trading as well. As trading signals, investing tips are very similar. If you're trading or investing just because somebody said, oh, you need to buy this stock's going to go up, you need to buy it, and you go, yeah, buy it, that's no way to invest, or it's no way to trade if someone says, okay, I think this currency pair is going up. However, if you've got a newsletter or you've got a signal service and you're using it to generate ideas for you, that's different. If you've got a magazine or something that says, okay, this stock is doing this, these are the numbers on it, these are the earnings, this is the story behind it, this is the current price, this is why we think it's a buy. You look at it and you go, no good for me. Next one, and you go, oh yeah. So it just highlights the stock for you. You then do your own due diligence and decide whether to allocate funds to that trade idea or not. It's a distinct difference, but trading just based on tips is just a gamble. You don't know what the guy's saying, what his motive for it is, how it might sound the best. I give you the best thing in the world, but whether it's true or not, you don't know. So by all means, take ideas, but do your own due diligence and research. Otherwise, you can get caught out in that. Number 3 is holding on to losers and taking profits too soon. It's a double-edged sword, guys, and we do this in trading as well as investing. You tend to. And Jesse Livermore, in his book, Reminiscence of a Stock Operator, have I got it? I normally have it to hand on my bookshelf here. I do, Reminiscence of a Stock Operator. Even in this book, Jesse Livermore made the classic mistake of, he had 2 trades on. One was a losing trade, I think it was in cotton. The other one was a winning trade in wheat, 2 different commodity trades. The winning trade in wheat, he cut it and held on to his losing trade in cotton. And he said that's one of the biggest mistakes he'd ever made. Actually, he lost a lot of money trading like that. But the point is we kind of have human beings, we tend to do that. We tend to want to hold the loser and see if it will come back and make us some more money. And we tend to kind of see the profit there in a particular trade or an investment idea and want to take it. We need to flip that thinking and say, well, actually, you know what? If I'm wrong about this stock idea, this trade idea, I need to cut it and just let my winners pay me. I'm right. I've been proven right. It's going my way. Yes, it could reverse and come back, but let's hold it. Let's see how much more this has got. Let's see when the trend goes, and try and flip that mentality of just holding those winners as long as you can while they're making you money, and just cutting the losers. You're wrong on it, you're wrong on the idea, just cut it. Obviously with a bit of room, but generally speaking, if you can tweak that and adjust it and swing it around the other way, you're going to do better. Your portfolio is going to do better. Number 4, this is a funny one, catching a falling knife or not buying at highs or not buying high. What do I mean by that? A lot of traders and investors will see a price getting pummeled and the stock going down, down, down continually, and they'll buy it thinking, well, it was at 50 and it's now at 10, it's a great buy, but the thing goes lower and lower and lower, goes down to 1. And it's a kind of false logic. I know, of course, there are, when you can time the trade and you can get it right or time the investment, fair enough. But often when a stock is broken, if you like, in terms of, they're not making any money or whatever the fundamentals are and there's no one interested in it, it can stay like that for a long time. So it could have been at 100 or 50 or whatever, maybe now down at 10, but it's for a reason generally. And whilst there may be an opportunity that you can put it in a sort of, not a drawer, but in a folder that says, well, actually, when things turn for this, I might be interested in the stock. Just buying it just because it's down X from highs is generally a bad idea. It's catching a falling knife. If the knife is falling, you're trying to catch it, most of the time, if you're unlucky, you're going to catch the blade and it's going to cut you. That's where that saying comes from. And it's the same with not buying at highs. If a stock goes up kind of 10% very, very quickly, people often are very cautious about buying it because they think, oh, it's up quite a lot already, I don't want to buy it. But in actual fact, that may be a catalyst and a sign that it's going to keep going and going and going. So again, it's kind of flipping that thinking and saying, well, that's good value because it was X, or that's bad value because it was X. Instead of anchoring your perception of value from a previous price, try and look at it subjectively just to what's happening now and what it's been and whether there's news out on it or what there's earnings or how you make your trading decision as opposed to, where it was. Okay, and the final thing, guys, is too much leverage. So very often, this happens obviously in trading as well. People taking on too much margin, trading too much leverage, it becomes far too meaningful. You get stopped out on a slightest little bit of adverse movement. You're in too big for the position size on your portfolio. And yes, when it's right, of course, you can make a lot of money. But the downside is, of course, is that you lose a lot of money quickly as well. And you'll tend to be not so tolerant of pullbacks and adverse moves. And so you'll come out and so you'll end up crystallizing those heavy losses far sooner than you would if you weren't leveraged or very, very low leverage and you could allow it to kind of mature and play out into the trade idea that you've got. So those are the 5 kind of ways that, or reasons that people lose money in the stock market. Any others, stick them in the comment section below. Otherwise, keep the risk managed. I shall see you in the next video. Take care, guys. Goodbye.